Welcome everyone. Thank you for joining us today. I'm August Biniaz. I'm joined by 𝗖𝗽 Benesocky. Welcome, Ava.
Thank you, August. Hi, everyone. Thank you so much for joining us today. Today, we are joined by Bridger Pennington, the founder of Black Bridge Holdings. So just before we start, I want to quickly just let everybody know, Bridger, how awesome you are. Bridger is the founder of an investment group that has done over 317 deals in the last 3.5 years. Bridger has started helping others launch their own funds through Investment Fund Secrets, an online program to help people start investment funds without working on Wall Street or having an Ivy League degree.
Like us.
Like us. Bridger has spoken on stage to tens of thousands of people across the United States and is on a mission. And this is what I love. He's on a mission to help entrepreneurs scale their businesses through launching their own funds. So welcome our guest, Bridger.
Welcome, Bridger.
Thanks, Ava, August, you guys are awesome. Thanks for having me. It's going to be fun. Get down to the nitty gritty of funds, how to launch them, how to start them, some good stuff.
Absolutely,
Incredible.
yeah. So we want to quickly give a background of how we noticed you, and you have a large exposure on YouTube, and I was on YouTube, and as I am a lot, and I know someone talking about how to start a fund. So I'm like, hey, we kind of have put us we have taken the approach of educating others. So we're like, hey, look, somebody else is there educating others on this concept of starting a fund. And funds are historically for a selected few, and they're this super exclusive kind of a platform to be part of. And it's amazing to watch you and kind of delving into it, especially since your father, I believe, is or was a fund manager. So you have kind of a firsthand information about how to manage and run a fund. So that'd be great.
And much respect to you to take an educational approach.
Yeah, to teaching others.
Yeah.
Absolutely.
Yeah, we've done both. So I can dive in a little bit how we started this thing and how it got in. You guys are all right with that? And then feel free to, you guys can lead the discussion. Let me know. I get ADHD and I'll get off track. So keep me on focus. I know you guys are great.
We love it.
You guys are great. So I was so just brief background on me. Hi, I'm Bridger. Like you mentioned, my dad currently still runs a $10 billion real estate fund and family of funds. They have about 117 funds under them, manage about $25 billion currently. Crazy. That's crazy what they were able to do. My brother, he is a chief compliance officer to 800. They just went from 300 to 800 in 6 months, $800 million real estate fund. And then I've ran my funds. I've run 2 funds. We're launching a 3rd one here pretty soon. And it's been pretty fun. I've done that for the last 3 or 4 years. So but it wasn't always that way. And starting out, I actually grew up in a super regular household, because you're probably like, oh, Bridger, it's easy for you, your dad, your brother, like it's easy, right? And yes, I have amazing mentors and stuff to help me. But we grew up in a super average house, super low key, just normal. My dad drove a really crappy car. And I, probably like a lot of people on here, wanted to be an entrepreneur, wanted to start some businesses. I wanted to make some money. So I got into college and started 6 businesses my first 2 years of college, got moving. And I was doing real estate wholesaling. I did Forex trading. I built websites for people. I did Chinese tutoring. I speak Mandarin Chinese. And so I just did all this random stuff. And finally, my dad grabbed me and he's like, Bridger, you're kind of like a chicken with your head cut off. You should go meet with my business partner. And he's a really successful guy. I think he can help you. So I was like, okay. So I went and met with this guy, and I remember driving to this dude's house, and I pulled up, and it was a gorgeous white home, gated community. It almost encompassed this entire cul-de-sac. I parked my car. I'm like, dang, who's my dad's business partner? Like, this guy is legit, you know? And so I walk up, I knock on the door. I'm a little bit nervous. I'm like, this guy's rich. Like, what do I do? And we sat down and we started to talk. And we talked about business and life. And I kind of finally asked him, how did you do this? Like, how did you get all of this? Like this house and everything. He kind of laughed. He's like, you know, no one really asked me that question. And I'm like, oh, I was a little embarrassed. Like, oh, I guess you don't ask wealthy people that question. That was really like my burning question was like, how did you do this? And he goes, well, we started funds. We started investment real estate funds. And me and your dad, and at the time, they're about $8 billion they managed. And to put that into perspective for people too, Grant Cardone Capital, and I love Grant Cardone, he's great. You know, they manage about 1.1 billion. So at the time they're at 8 billion, so 7 times bigger. Now they're up to about 25 billion. Okay. So just the scale is huge, right? Of a fund. And I was blown away. Talk to me about how funds work, how some of the most wealthy people on the planet run funds. And I was very intrigued. I wanted to start this. I wanted to get into the fund space. And I said, hey, can you be my mentor? Can you coach me? And he's like, Bridger, go talk to your dad. Your dad knows way more about us than I do. And I was like, no, hold on. Like, my dad's poor. You're really rich. Like, can you be my mentor? Like, you're the guy, you know? And he's like, no, like he goes, me and your dad make about the same amount of money. And I was like, my jaw like hit the floor. I was like, what? Like, are you? And he's like, yeah, we're like pretty much equal business partners. And I remember I left his house. I drove straight to my dad's house. I was like, Dad, what the heck? Like, what's going on? Like, why have I not been able to order a soda at Chipotle for the past 10 years? Because it's too expensive. And you run this huge fund. And he kind of laughed and he was like, well, you know, I like to save and invest my money. And my partner likes to kind of spend and show off his money. But yeah, we run this big fund. And so, sorry, I'm getting long-winded here, but long story short is we sat down and my dad started to teach me and coach me about how funds worked. He taught me how they were structured, how to put them together, how to file with the SEC, how to raise money from investors. And I got pretty excited. I thought through, and about the next year, I found a great opportunity to start a fund. And I remember taking this idea to my dad. I said, Dad, I got this great idea. We're gonna do these micro loans. They were like $5,000 to $15,000 a piece, short-term, fast-turn loans. He loved the idea. We mapped it all out. And I kind of overlooked one piece. The biggest piece for a fund, obviously, is you need investors. You need money, right? And I for whatever reason, I didn't really think about that much. And I remember I was like, crap, I need some money now. So I thought, well, my dad is rich. He doesn't spend his money. He likes to invest. He would love to invest in my fund. And so I remember it was a late Sunday night, I went and met with my dad. I sat down, I talked with him. And he said, I was like, and my best pitch voice possible. I said, Dad, how would you like to be our first investor into our fund?
Nice.
And he kind of laughs. He goes, Bridger, if I invest in your fund, I would ruin the experience of you raising money on your own. This would be a crutch that you can never recover from. Your first investor is your hardest investor. If I give you money, you will never recover from this. And it was a big, tough love moment. And he said, no. And kicked me out. And to this date, I've launched multiple funds, tons of deals. And my dad, to this day, has never invested in a single deal I've ever done, ever. And, but he's been the greatest mentor ever. He's always there to answer a question, to help me out, but won't do it for me. And I really respect him for that. He's just an incredible man. So anyways, I went out, I hit the streets. I talked to every person. I'm sure people on this call have done this before. You talk to everybody, you know, former boss, college professor, friend, family, anybody. After 3 weeks, I raised a whopping $49,000, which is teeny, right? Just like the smallest fund ever, but it was enough to get started actually. In our fund, we were doing these small loans. They were like $5,000 a piece. We started to do these loans, and our first investor group got a 64% return on their money. Oh. And they were ecstatic. They loved it. And it was obviously a small amount, but it was a good return, right? And from then we use that as kind of our track record, our base, and we've launched our second fund, and now we're launching our third fund. We've raised and deployed millions of dollars since then and grown a ton, but that's kind of how I started, at least, and got going. And then since then, I've had a lot of people ask myself, my dad, and my brother, how did you guys do this? Because my dad, he grew up in ghetto North Las Vegas. He has the total rags to riches story, you know, barely graduated college, like the whole thing, right? My brother and me, we didn't grow up we didn't go to Ivy League school. We're not in the Vanderbilt family. We didn't, you know, we're not the Rothschilds, right? So we had to figure out a different way to do this, and the anti-Wall Street, the anti-Ivy League route. And so we had a lot of people ask us this, and that's why we started, which you guys mentioned at the beginning, Investment Fund Secrets, is just a way for us to share to other people about how funds work. And yes, it's complicated. Yes, it's hard, but it's not as hard as you think. It's not as crazy as you think. And no one talks about it. For whatever reason, nobody talks about how private equity, hedge funds, venture capital funds actually work and run. They give you the high level, the kind of fluff. They don't really get to the guts of it. And that's what we try to get into and help people do. And it's been pretty fun. So I do both right now. I run multiple funds, and we help teach people as well.
Amazing. Oh, that's awesome. Thanks for that great story and background. And I mean, that's what you, as far as you speaking about your father and his frugality, that's what you want from a fund manager. You want a fund manager to be frugal, not prodigal. So that's amazing for him. And also that speaks also volumes about your journey where you're teaching others. Usually you hear these stories about kids that are children of people who are hedge fund managers, and you don't see somebody who's out there educating others. So we definitely have to give you the accolades and the applause that you deserve. So just
well, not to me, to my dad and my parents. I have incredible parents, and they were very smart, I think, about how they raise their kids. Yeah,
definitely salute to your dad, and I look forward to possibly having him on our show at some time in the future. So that'll be great as well. But awesome. So I wanted to kind of briefly. So there is, in the world of private equity, there's a lot of terms that are used, and at times it gets convoluted. So could you please kind of describe to us what is the difference between private equity funds, real estate funds, venture capital funds? So people hear these terms all the time, but what those three? Let's talk about those three major ones. What differentiates these three funds, if you may?
Yeah, great question, and that's something I was way confused about. I was like, what? Like, I know they all kind of do something. I don't really get it though, right? And by the way, I see a bunch of people here from Canada. My mom's from Canada, Alberta. I love Canada. I'm gonna be
Alberta.
You're from Alberta?
Yeah, my mom is from. She grew up in Cardston.
He's from New York, remember? Wait, no, Salt Lake City.
Salt Lake City, yeah, but I love Canada.
You're from New York, so I'm like, no, I don't think he's from New York. Earlier on our link, then, so I'm like, everybody who runs a fund is from New York. So, but please go ahead. Sorry for interrupting.
Oh yeah, I started a fund in Salt Lake City, Utah. If I could do it here, you can do it anywhere, okay? As well. So, but I love Canada. The border's been closed for a while. I wanted to go up and see my family. I have a ton of family in Southern Alberta. I love it down there. So it's great. But so back to the question though, back on topic here.
Yes.
What's the difference between private equity, hedge funds, venture capital, debt funds, real estate funds? You hear these terms, like, what does it all mean? And it's been actually very freeing for me to dive in and really study and dig this out. They're all structured pretty much the same. They're all, and the basic, I will kind of go basic to advanced here, but the basics of just a fund in general, all a fund is a pool of money. Investors put money into that pool, and then us as fund managers can draw from that pool, and we can go do whatever. We can go buy real estate. We can go trade cryptocurrency. I have guys in my group that buy and sell funeral homes out of their fund. They'll buy up mom and pop funeral homes for like 500 grand a piece, and they can sell them for double on the public markets. Other guys that do almond farm funds, other people that do, they buy movie scripts off of Hollywood and sell them to HBO or Netflix. I mean, that's a fund, right? And so yes, you have traditional buckets and categories, but funds, I mean, you can do pretty much anything. All it is just it's a bucket of money. That's all it is. It's just a money that you can go use to try to turn into more money. So when you hear private equity, hedge funds, like what is that? What are the kind of those buckets usually? Private equity is a fund, and they typically buy private companies. They buy private equity in private companies. So a great example is Sycamore Partners. They're a huge private equity firm on Wall Street. They own 9 West. They own Aeropostale. They were going to buy Victoria's Secret last year. It fell through. So they buy private companies, private brands. You'll see Blackstone, KKR, they go buy the MGM brand. They'll go buy these private companies. And usually what they'll do is a number of things. They'll buy them, they'll tear them apart and sell them in pieces. They will take them and IPO them. There's small cap private equity funds. So like my buddy that was buying funeral homes, that would technically be a private equity company. They're buying private funeral homes and then just selling them to a bigger private equity company that wants a group of homes. So that's typically private equity. That's what you're talking about there. Hedge funds, same thing, same pool of money, but typically hedge funds are trading on the public markets. So hedge funds are going to trade on the New York Stock Exchange. They're going to trade Forex or crypto. It's more things on public exchanges. They're going to trade bonds, stuff like that. Same model, same thing, but they're just trading different things. Real estate funds, obviously they trade real estate, right? They're buying and selling real estate. It's the same thing. Debt funds are usually issuing loans. So my fund is a debt fund. We're doing loans. So that's kind of your categories. Venture capital is similar to private equity, just they're early stage seed companies. So they're investing like Shark Tank into early stage companies, and they'll usually bucket those as venture capital type of funds. But when you get down to it, the actual structure and the filings with the SEC are all pretty much the same. So that's why we've been able to coach and mentor hundreds of students, regardless of if they're doing a real estate fund or private equity or hedge fund, because the structure of the filing is all really similar.
Amazing. And we're going to share Bridger's contact information. So you guys actually have a system where you assist entrepreneurs who want to start a fund with the whole process. And I was watching one of your videos where you even have the right lawyers that are going to give a better price to people who come through your team. So that's incredible. So looking forward for that. If you like this here.
For sure.
Yeah.
Bridger, we were wondering if you could explain the lifespan of a fund and what is common as far as a fund being open-ended or closed-ended.
Yeah, great question. And yeah, I guess you guys have links, whatever, we can drop it. If you guys just find me on Instagram or, Bridger_Pennington, stuff like that, we can start chatting and stuff. I don't have a ton of followers, so like, we can chat for, I'm not like a million follower kind of a person that's not gonna respond to you. So I'll respond to those people on there. But so lifespan of funds, okay? So different funds will do different things. And the two main categories are open-ended versus closed-ended. Now, before I get into this, the best thing about funds is there's two main documents of funds. They're called your LPA and PPM. And those they're limited partnership agreement, private placement memorandum. What they are two really thick legal documents. They're about 100 to 200 pages each, and they cost you a lot of money. But we call them the Bible in our terminology. We call them the Bible. And yet the best part about funds is you get to write the Bible. So for your fund, there's actually a lot of leeway and decision making on your end. You can really decide exactly what you want to do. So I'll give you a few examples. But again, I mean, every fund is awesome because you can decide, hey, we want to charge this amount of fee and this amount of carried interest and this type of investment strategy and things, and you can just put that in your documents and it's ready to go. So now back to your original question of the lifespan of fund. Two main categories most people do is open-ended or close-ended funds. So the first one, open-ended funds. This is typically with a trading, like usually hedge funds will use this. Open-ended meaning that there's a start date, and once the start money comes in from investors, and investors can come in and out of that account. So if you're a hedge fund manager, you start with $10 million, you're trading 10 million, and then more investors come in. Now you have 20 and 50 and 100 million and 200 million. You kind of get bigger and bigger, and then maybe an investor wants to leave, and they can leave and they can come in and out. And typically you'll have some kind of period. They have, like my fund is an open-ended fund. Investors have to come in they have to stay with me for at least 1 year. If they go out early, they have a penalty. And then after a year, they give me a 60-day notice and they can work their money out. Kind of how an open-ended strategy. Typically you see hedge funds doing that. Now I know this call, we're talking about real estate, right?
Quick point on that. Are they selling back their shares to you after that year if they wish to leave, or is there a secondary market they can trade it on? How does that work?
Yeah, great question. Depends on how you set up your fund. So some funds will allow a secondary market if you want to trade shares, but the problem is you're not a publicly traded company, so you have to facilitate in that. You are under exemption in the SEC, so you can't publicly. At that point they're selling a security, and so then it becomes regulated. At least in the United States, it's that way. So typically they will sell their shares back to the company, and you have your net asset value, and you'll trade that for just money out of the fund. Typically is how it works. Now in real estate funds, which is probably most people on here that we're talking about, typically do a close-ended model. And you'll see that in real estate and private equity. So typically, and my dad's funds are a great example, and I'll walk you through how their funds are structured. They put their funds on a 10-year timeline. And they're doing multifamily value add. So and this is kind of just an example, this is not true for everything, but this is how they do it. So they say, hey, the first 18 months, we're gonna raise money and start deploying capital. So for 18 months, we're gonna plan to raise $100 million, and they do different closes and stuff in that 18 months and different marketing strategies to raise money. They raise, and as they're raising money, they're buying in properties. Once that money's in for the 18 months, investors cannot get in or out of that fund. It is a close-ended, locked-up fund. An open-ended, investors can come in and out. A close-ended fund, you are locked in because you're going to start buying these big real estate properties. And if an investor on year 2.5 is like, you know what, Bridger, I want out of my $20 million, you're like, well, shoot, we have to sell an apartment complex to get your money back. And it hurts the entire fund. With a trading fund, you just sell shares of Apple and Google, and you can just liquidate your investors. With a real estate fund, it's a little bit harder to liquidate. So typically they'll do close-ended funds. So first 18 months, they raise 100 million. A year 2, 3, and 4, they are acquiring properties and they do a value add fund. So they will essentially they're flipping $100 million properties is what they're doing. And so they'll put in dollars to renovate it, put in a new basketball court, renovate whatever units they're going to do. And then they try to sell at year 5, 6, and 7 is when they try to sell. But they say, hey, depending on the market conditions, we can hold until year 10. So if we have another 2008 happen, no worries, we'll just hold on until the market recovers and we'll sell in year 8, 9, and 10. But they say, we guarantee your money will be back in 10 years. But our goal is to have your money back to you in 7 years. So that is, and that, sorry, we can ask questions or go back over that, but that's typically what they call a close-ended fund, because you can see there's a start and an end date. So you're probably asking people who are thinking, well, man, that's a long time before I get paid, right? Like that's like 7, 10 years. Like, why would I ever do that, right? So what a lot of funds do is they will stack funds on top of each other. So for instance, they will do fund 1. So we had, multifamily real estate fund 1, we launched 18 months, we raised money and we start deploying capital right after that first 18 months. So if I don't know if you can see my hands, they will launch fund 2 right after. Hey, we're going to launch fund 2. We're still going to do multifamily. This time we're going to raise 300 million. And they will keep raising money on fund 2. And then, hey, 18 months later, we launch fund 3 and we have fund 4. And so after you're building your business, after 5 years, every about 6 months or 18 months, you have an entire fund that's finishing, and money is, and you're managing 8, 10, 12 funds, and they're all spitting off cash to you, and they're closing and opening at different times. And so you have a consistent cash flow and a lot of money coming your way as a fund manager. So typically you'll see that inside of a close-ended fund model. Typically close-ended funds are venture capital is another great example. You invest in a bunch of small startups, right, early on, and you have to wait a couple of years for them to succeed. So you got to wait 4, 5, 6 years for them to IPO or get sold or have some big liquidation event. So that's typically the open-ended versus closed-ended model.
Amazing.
Does that make sense?
That was great. No, definitely. Yeah. That was awesome. We had a question that came in here, and it's a great question. And this is, it's a little bit off the topic, but that's totally fine. It's about how to recognize a fund opportunity. And this is a great question because is there a market for funds? Where do people, if people are interested in investing in a real estate fund or a venture capital or private equity, where do you go? Where do you look for such a thing?
They say, is there a process to follow?
Is there a process to follow?
Yeah, great question. So, and kind of 2 questions there. If you want to invest into funds, if you're an accredited investor, if you have a few million you want to put into funds, the thing with funds, most funds in the United States at least cannot publicly advertise. So that's why you don't see TV ads, you don't see billboards for funds, because they can't. It's against the law. I right now on this call, I could not tell you about my fund and advertise it. It'd be against the law for me to do that. So, but what you can do is there are plenty of investor clubs. You can join, even Facebook groups now. It's crazy. You can join these groups and talk to registered investment advisors, broker-dealers to find funds, and they're always looking for money. Once you talk to one, you'll get 100 referrals to funds. Now, I think the other question is how, like me, if I wanted to start a fund, how do I recognize a good opportunity? A fund, in the nature of it, is the perfect catalyst to extreme growth. So what I tell most people, and we have a process called the fund launch formula that we walk through a lot of our students, a formula of doing this. The first step of that formula is finding that incredible deal, that opportunity like you're talking about, so that you can bolt a fund onto it and scale to the moon. So now I'll tell you what I am. I'm really good at setting up funds. I'm really good at teaching funds. I'm not an investor coach. I don't teach people how to invest. I teach you how to set up funds. So just a few things though, I still know about investing. I still know how to do it, but I don't teach it because there's other people that do it better than me. But recognizing a fund opportunity. Number one, a few things that I see is, and I think a great example, this is actually the example my dad gave, maybe I won't get into that yet, but on a brief note, we'll talk about it later. That's more on money raising and trying to find capital. But for a fund opportunity is something, first off, that you are confident enough to put all of your money in. And maybe not all, but a good portion of your net worth into. If you're going to be asking investors to put money into, you should probably be really confident in it. Number 2 is testing that concept out. And we even teach people, before you set up a fund, it's probably smart to do a few syndications. So in real estate, flip a few houses, right? If you're going to do a house flipping fund, go flip a couple houses or partner with somebody who already does it. So that's the other side of the coin. So either do it yourself. If you're going to be a trader, go trade your own money first, practice it. And then all a fund does is allow you, instead of trading $10,000, now you're trading $10 million, right? And if instead of flipping 2 houses a year, now you're going to flip 85 houses a year. We have a guy in our group that's actually doing that right now. Just raised it. He went from 2 houses last year. He's already in the process of flipping 84 houses in this year. All fund does is scale that. So if you are not that person, and I'm usually not that person, to be honest, I'm not the expert like Wiz that can trade cryptocurrency in the middle of the night. Like, that's just not me. I'm good at setting up funds though, and I'm good at finding investors. So I go find what I call broke geniuses. And these guys they're not broke. They're making a couple $100,000 a year flipping houses or doing whatever they're doing, opportunity zones or whatever it is. And you go to them. And this is actually how my dad's fund started. My dad found a couple guys flipping real estate and said, hey, how would you guys like to run a fund? Like, and really play with big boy money. And they're like, yeah, I'd love to. I just don't know how to do a fund. And he said, well, I know how to do a fund. I have a partner who can raise money. Let's partner up together. And so they all partnered up together. My dad ran the internal workings of the fund, how a fund works. His other partner raised, he's a really great networker. And the other guys were really good at real estate. And today they all needed each other. And bam, they took off like crazy. It's funny today, my dad, $25 billion real estate fund, doesn't really know a lot about real estate. I asked my dad about real estate questions. He's like, I don't know. He's like, I have partners though, that they know how to do it. But like, I just know how to set up funds and file the SEC and like do all the structure of it. And so that's what I would say. If you're not that expert investor, that's okay. Partner with someone who already is doing it, already has a track record, because typically they have no clue how to set up a fund. Very few people know how to set up funds, let alone actually do it. And so when you say the word fund, when you talk to people about funds, their eyes kind of light up. They're like, whoa, and they want to talk to you more. It's just a weird thing when you bring up like, hey, I'm working private equity, or run a private equity fund or a real estate fund. People won't let you stop talking at a dinner party. Like, no, tell me more. They want to learn more. They want to like, why, how do you do that? It's just such a secretive world. So it's actually not as hard as you think to land those types of partners. Great question though.
Well, that's great. The great answer. I really appreciate that. And it kind of opened a few questions in my own mind and comments I wanted to make. Is that our group has plans, inspiration to be a fund eventually. We're looking into it. Now, starting a fund in Canada is a lot different than starting a fund in the US, especially a real estate fund, where in the US, a real estate fund has an exemption where you don't need a fund manager, where in Canada, you do need a fund manager, and cost, the eligibility to be a fund manager is very extensive and very costly to manage a fund. And also, as you also mentioned about advertising and marketing, makes it difficult to advertise, market, and raise capital as well. So because of those constraints, we haven't taken the step yet. But so we are syndicated. So we're syndicated investment. We find one deal, we raise capital for that deal, we raise the exemption in place to be able to raise the capital, and we complete the deal. So essentially, we are a one deal fund in a way, you could say. So it's called a real estate syndication is what we do. But that's one point I want to make. But other point was about this concept. So I noticed a lot of fund managers who don't have any experience in any business. And for example, cryptocurrencies and Bitcoin, it's something that's in the news all the time. I've been involved in investing in cryptos for a long time. And what I noticed is certain fund managers are now getting involved. So I'm like, hey, hold on a second. This particular fund manager has no knowledge about cryptos. What is he doing? Because you want to think that the misconception is that the fund manager needs to be an expert in what the investment is. But just like my background as a builder, as a general contractor, where when I build a house or when I build multifamily, I would manage the project, but I would bring on an expert. So if I want to build a roof, I don't know how to build a roof, but I'll bring on a roofer. I know how to manage a roofer. I know how to make sure the job is done properly, how to pay the roofer. So I bring on the expert to do the job. The same kind of idea for a fund manager is, depending on the business idea, you bring that expert, in your father's case being in real estate, you bring on the experts to do the job needed for that particular process. So that's great to discuss.
Exactly. Yeah, well said. It's exactly how it works. Yeah, no one does it alone, right? Everyone has partners. Everyone has other people around them and builds teams.
Exactly. So let's quickly touch on, there's some questions about an EMD and exempt market dealers that are coming up here. So again, the process of raising capital in Canada is a lot different than in the US. Also, the terminology used is a bit different. I have some questions from you in regards to international investing. I saw one of your videos, and we'll get into that in a minute. But talk to us about what you mentioned that you're good at as far as raising capital. Talk to us about the process of raising capital in the US. can a secondary, I believe they're called broker dealers in the US, the brokers of capital, be used to help and assist a fund manager or a syndicate manager to raise funds, and how that process works?
Yeah, great question. And by the way, syndicates, that's the best way to start. Do syndicates, and you guys are doing it. That's awesome. And you can stay at syndicates and just grow that way. And funds is another way to scale. So that's awesome. Kudos to you guys.
Thank you.
In regards to raising capital, yeah, every country is going to have a little bit different laws and regulations around it. And don't let it scare you. Don't let it, I think too many people just go, oh, it's too complex. I don't want to learn it. I'm just going to stay out. And I think that stops so many people that could have had amazing syndicates or funds from going forward and doing this. So in the United States, I speak the US better. I don't know Canada law that well for specific laws on it. I can teach you the strategies though for raising money are the same in Canada or US, right? All over the world, but the actual laws around it. So in the United States, yes, you can raise money through a broker dealer or a registered investment advisor, the two main entities that'll do it. They typically are like, if you go to an investment, specialist or investment advisor, they teach you how, they're like, hey, you should invest in the stock market. Those types of people, they have a license in the United States to recommend and sell securities for a fee or commission. And so in the United States, if you want to use one of those groups, they typically will take a fee or commission on the sale of the security. Sometimes it's around maybe a 0.5% or 1% of the money raised for recommending their investors. Now they have to have a license in the United States to do that. So they need usually a Series 7 license or a Series 65 license, what they're called, to do that. Now, most first-time funds though, like my funds, I don't use those guys at all because number one, they don't believe in me. They're not going to trust me enough because they typically they're more institutionalized. They're not going to invest in a first time or even second or third fund. Maybe the fourth or fifth fund of a fund manager that's ran for 10 years when they start looking to invest into those funds. So my dad's funds, for instance, they're established, they do well. They can go to a broker dealer or investment advisor and get some of their clients. But typically at my level, and if you're under $1 billion, I would say, most of the time they're just going to say, sorry, you don't meet all of our due diligence checklists. We're not going to work with you. So typically money raising for me is personal network. It's back to the, you're going to networking meetings, you're meeting people, you're working on investors, you're pitching them, and you're asking about funds and getting investments in. We're launching our third fund right now. We've got about 15 million in soft commitments that we've raised in the past 30 days, all by personal network and word of mouth. We just start pitching investors, and that's what we talk about. That's what I teach our students is just get out there and start pitching investors. I see a comment on here. What do you start first on? Do you start the investor first or the deal first? And I think you do both in tandem all the time. You're always talking to investors and you're always looking at deals. And when you find a great deal, you say, hey, Mrs. Investor, Mrs. Johnson, do you want to come check this deal out and do the pitch? And 5 out of 10 times I'm going to say no, and don't burn that bridge. Just say, hey, okay, I'm going to bring you a better one next time. What kind of deal do you want? You're always working on those relationships. And so with me though, so back to this new fund we're launching, 15 million in 30 days, right? It's done pretty well. From my network has probably been about 4 million of that. I partnered with a really good guy who has a really great network. He's a natural born salesman. He's networked for the last 20 years, just has no idea what to do with his network. Oh, wow. And there are people like that everywhere. I met a guy the other day, good friend of mine. He calls me, his name's Tyrone. He's like, Bridger, hey, what's up? I'm like, hey. And he goes, dude, I've got 3 billionaires that are good friends of mine that want to invest into kind of my deal and my fund. And he's kind of been traditionally like the money raiser type of guy. He's like, I want to be a part of this. And I was like, I don't know what to do with these relationships. And I was like, well, come on over. Like, I'll take them, like, this is great. Let's do it. And so there are people like that already have these incredible relationships. They just don't know what to do with them. And again, back to, it's not the how, typically it's the who. It's not how do I raise money? It's typically who can I find that can help me raise the money? Or who can I find that can help me build the fund? Or who can I find that's already good at trading cryptocurrency that I can just partner up with? Is typically, now you can learn stuff yourself, but that's the faster route. The faster way from point A to point B is typically landing great partners. And so that's what we've seen with money raising. And I can go deeper if you want me to into how I pitch though and raise money from investors and stuff like that and build out funds. But
No, that's fine. We want to kind of everything on a high level, just for people to get to know you and pick your mind. And if you like, Ava, for this question.
Bridger, we were wondering, can you explain the duties and responsibilities of a fund manager and the team needed to manage a fund? I mean, as we say here at CPI, this is a team sport.
Yeah, great question. It'll change a lot throughout the life cycle of a fund. At the beginning, my fund, it was just me doing everything. So I raised all the money, I did the deals, and I managed the fund, right? It's just one man pony show, whatever you want to call it, one man band. And as you grow though inside of your fund, and it depends a lot too on you guys are in Canada. I don't know exactly how all of it works in Canada, but I'm guessing it's still in the United States. But as your fund grows and hits certain thresholds, you will be required to have certain compliance, certain regulations, certain accounting, certain audits you have to do. And that's kind of the stuff when you talk about managing the actual fund, how it works. That's the kind of stuff you got to start thinking about. So your accounting firms that you hire, the name on the accounting firm means a lot to some investors. The type of auditor that comes in and will audit all your books, they're going to look through all your stuff. And having the right legal counsel and stuff like that internally, but you'll build that as you grow. The other thing though is nice. This is the best thing about funds, is you control all the money. It's the golden rule, right? The one with the gold rules. When you have, because you might be like, man, Bridger, that's expensive. That's a lot of overhead. I don't want to pay for an audit. I don't want to pay for accountants and lawyers. It's like, wait, hold on. You're good, because you manage $100 million. And okay, all of that costs 200 grand. Cool, right? You write a check. That's like 0.2% of your entire fund, Okay. And it's a write-off. It's a business expense of the fund, and you pay that there. And that's the thing about funds, is you have all the money. And so you can hire people, you can bring on consultants, you can bring on different people, because you're the one with the gold. And so those things will come. There are great third-party administrators too that you can hire. So there's companies that do this for a living. So you pay them a yearly fee of maybe it's $30,000 to $50,000, $70,000, and they will come in and manage all the interworkings of your fund, making sure that all the numbers are just right in the capital calls and distributions and equity percentage, and they calculate your net asset value, and it's great, and you don't have to worry about that. And so when actually running the fund, there are plenty of resources. Again, don't let it scare you, right? You have the money, you have the gold, and you can hire out different people and build an incredible business. Jeff, Elon Musk doesn't build cars, doesn't build rockets, doesn't know how to do energy, doesn't know how to do anything. All he knows how to do is set a great goal and build a team. And that's what you're doing inside of it. It's the same thing. And because you have so much money around you, it makes it even easier to do so.
Very, very well said. And with us, what we noticed is what our company was missing was the assets. We're like, okay, great. We have a great investment group that are investing with us, that we have our thought leadership platform, the business model, the business plan is there. Now, as far as these assets and the assets will be managed by the property management team, but how are we going to have this deal flow coming in, and how are we going to have somebody who's experienced to oversee the project? And we came up with a concept of regional asset managers, and we looked at what are the areas we want to be in the US, Arizona, Texas, Georgia, and North Carolina. And we're like, okay, let's look at these areas and see who do we want to be our boots on the ground, who will have decades of experience, who are active real estate investors, who also run an investment company. And we brought on our regional asset managers in those regions.
Our incredible regional asset managers.
So now also another thing I wanted to kind of speak about was, now these things might get a bit complex and confusing, but now imagine needing to do the process of raising capital and investing cross borders. And that kind of brings the topic to international investments. I was watching one of your videos about international investors being able to invest in US funds. So, and I'll quickly talk about us and how we structure it. And then I'll look forward for you to discuss that a bit. But for us, so luckily there's a treaty between Canada and the US, which allows for certain tax exemptions for Canadian investors looking to invest into US real estate. And now the web of corporations, limited partnership, and the structure that needs to be created doesn't make sense for a single investor. But when you're doing a syndication, buying a $50 million asset, it does make sense spending 150,000, or I'm just throwing out a number there, but it makes sense to spend that for your accountants and for your legal team and your offering memorandums on this side of the border and your private placement memorandums on the US side. So it makes sense to create the structure to allow the Canadian investors to invest into the US entities and also get relief from double taxation, as long as they have a certain income in Canada, and as long as they have taxes they pay in Canada, they can write off the taxes that are have been withheld and have been paid in the US on their Canadian income. So Bridger, if you like, please describe a bit about the US funds. Can US funds raise capital from international investors and how that process works?
No, I think you described it great. And I'll kind of go even more broad. And I'm not a tax expert. This is not financial advice or tax advice, but anytime you cross a border, you are now dealing with two countries' tax laws and two countries' securities laws. And so what happens, and plenty of funds do it, so it's fine, right? Again, you have the gold, you rule, so you can spend the money, okay? So, but typically, you want to first off make sure it just, like you just said it perfectly, and make sure it justifies the cost of the legal, because now you're not just hiring one accountant or one lawyer from one country. You probably need to hire accountants and lawyers from both countries to figure out how that works and how it's going to be structured for that investor. So typically, you want to make sure it's just worth your time, essentially, to go out and do that if it's a big enough investor from a certain country. Now, what a lot of funds do that are bigger in scale and really raising money internationally. Now, this is down the road for most funds. I've not gotten to this point yet because I don't need to. There's plenty of money in the United States for me, so I don't need to yet. But if you're raising a lot of money internationally, my dad's funds are a great example. So they raise money from all over the world, and they will do a number of different things. So I'll give you a few metaphors of what they'll do to mitigate tax risk and securities risk. So for example, and this is not true, but this is going to be a metaphor so you guys know. So don't go copy this or whatever. But for example, if they raise money from Asia, so Hong Kong or South Korea, they raise actually a lot of money from over there. And when they raise that, it comes through, instead of just coming directly in the United States into the fund. If they did that, that investor would get a K-1 and they would have to file US tax return, like you mentioned, August. So what they do is they will set up a Cayman Islands feeder/blocker fund. So the investors will invest into the Cayman Islands fund, and that fund will invest in the United States. Now, I know every time you hear about Cayman Islands funds, you think of a scam, you think of Bernie Madoff, right? This way is, and I know it's probably a scam there, but this is a legal and totally normal way to do this, and it doesn't mitigate taxes in this scenario. All it does is it allows those investors to not have to file a US tax return. What happens is the Cayman Islands fund, that fund pays all the tax to the United States, and then it just issues a lesser distribution to its investors overseas. So those investors don't have to pay taxes directly in the United States. That's what it's doing. So now, for example, that's not all international countries obey and are good with Cayman Island law. So this is just metaphors, but if you were investing from Spain, and this is just a metaphor again, I don't know if maybe Spain's laws don't work with Cayman Islands, so they will set up an Ireland tax entity. They wire their money into Ireland, and then that Ireland goes into actually Alberta, Canada is a really great tax haven. So they'll go to Alberta, Canada, and then they'll invest into Delaware. And the funny thing, I actually have heard this from multiple funds. If you have a Canadian, so there's a lot of Alberta, Canada feeder funds. These are called feeder funds that they have that flow in. If you're in Canada, though, you can't invest into the Alberta feeder fund because you get double tax. So you have to invest into like the Virgin Islands fund and then invest into the Delaware fund. For whatever reason, Canada's tax law doesn't allow that. So, and again, this is metaphor. Don't take that as tax because I don't really know exactly. And tax law changes all the time. But what that shows you is when you get to that level and you're going to raise money from all over the world, you will have really great accountants and really great tax people that understand how every country's tax laws work, and they'll set up these different feeder funds that all feed into your Canadian fund or US fund, and that's typically how those funds are structured. They're called parallel funds is the terminology. So they have parallel funds that are next to each other for different tax purposes for different investors. Does that kind of make sense?
No, definitely flow through. We call them flow through in our case.
Yeah.
International. A quick question now. This kind of directed to you, and currently talk to us about the fund that you currently manage, and what stage is it at? What kind of returns can investors expect? What are you guys focusing on? Kind of touch on that, please.
Yeah, great. And again, because of law, I cannot pitch you my fund. I can't get into like the specifics because we're on a live call here, but I'll tell you kind of what we do. I'll kind of
We're in trouble.
Yeah,
Sorry.
careful now. Careful.
I'll talk around. I'll talk as much as I can though. So at the beginning, I mentioned our fund does short-term loans. We do small. We still do that. So inside of our second fund, we do small micro loans. They're anywhere from $1,000 to about $35,000, $40,000. They typically last about 5 to 6 weeks, and we make somewhere between 15 and 20% return in 6 weeks. So, I mean, we turn our loans really fast. These are small micro bridge loans. We only do them for it's a really niche industry. We have partner companies that send us clients, and that's what we're in. And we are really the only one that does these types of loans, which is awesome. We have zero competition really in this space, which is really awesome. So we do these loans. I've done them for 3.5 years. We've done all sorts, and then we also will do hard money loans on real estate. You guys are probably all familiar with that type of lending. We'll do those as one-off deals. We don't do those as common. We do, every month we're probably doing 50, 60 of these small micro loans and we're turning our entire fund about every month almost. So we are a fast turn fund. Our first year, for that first fund, we got a 64% return. Next year, we got about a 49% return. This year, we're actually still totaling it up. Should be somewhere around a 36%, somewhere in there. So high yield, high return fund. Our investors are super happy. I've had to turn down investors just because I can't deploy their money fast enough. Our loans are so fast that we roll our entire fund every 6 weeks. And so that's the one problem with my fund. Sure. Is if somebody gave me $100 million, I couldn't deploy it. I would just be like, sorry, I don't know what to do with it. Because there's only so many $5,000 loans you can do, right? So that's the reason we're launching a third fund, actually a real estate fund right now. To go and buy. I'm not going to spill the beans. My business partners would be mad at me if I told you all the beans of what we're doing. But we're going to go buy all these real estate assets, a value add type of real estate fund, and we're going to use all the investors we have, and we want to raise about $75 million for that fund over the next 6 to 8 months.
And for your short-term loan fund that you currently have, are you raising capital on that? And what's the minimum investment? Is there any cash flow? How does that work? Is there any distributions kind of idea?
Yeah, great question. So we're not raising money for it. I have too much. My investors are trying to always give me more money. Minimum commitment for that was $50,000 per person. That was just when I set it up. I was like, oh, let's just do 50, right? As a minimum. People have gone, way above that. And we pay out on a monthly basis because our loans are so quick turn. I give my investors a check every single month. And we run an open-ended fund like I talked about earlier. So investors can come in and out. We've had no investors leave. They were all like, this is great. Keep me in. Give me, they want to give more money. And we give a monthly check on. So essentially how we think about it is we have our base of money. Every time we make profits, we just scrape off for that month all the profits. We distribute those to our investors and we go back to our original principal. And then we just work up from there. We scrape off the top, we distribute. And that's how our fund currently runs. So it's a cash flow type of fund. I would say less funds are like that. Most funds are, hey, you put money in, you wait a year, 2 years, 5 years before you get paid out. And then you get paid these huge checks at the end. But our fund, we decided to do more of an open-ended fast turn just because we could.
For sure. Yeah, it's a great time to kind of come to this question here.
Of course. And
Yeah.
Richard, could you please describe how a fund's management team gets compensated, assuming this is done through fees? How are these fees structured?
Yeah, this is a great question. Can I actually share my screen? Is that okay?
Yeah, no, absolutely.
Of course,
Please do.
yeah.
Can you make me a co-host?
Yeah, I'll make you the co-host here.
There we go.
Hopefully this works. There we go. Yeah, this will make it way easier. Oh, I need a plug-in. Dang it. Okay, let's see if it works. So I'm gonna map it out. This would help me understand so much how fund managers make money and how this all works. Can you guys see that okay?
Yes.
Is that working? Okay, so I'm gonna draw on here. Let me get my little pen going here. Okay. So the timeline of returns out of a fund. You guys are all pretty smart here, so I'll go quickly. I'm sure a lot of you guys know this. So on here, 0% return. I'm gonna, for this example, we use like 20%. This is we'll call it returns or just IRR, right? Just to keep it, we'll keep it simple. I know IRR, we can get complex on how that number is calculated. We can just call this yield, right? We'll just keep it simple though. Your yield. So if I got a 10% return this year, that would be right here in the middle for our fund. Okay, and this is how fund managers and that's why fund managers make so much freaking money is because of this. Okay, so now you've probably heard of a 2 and 20 fund. I'm sure a lot of people have heard of that. It's a little more complex than that. And so I'll kind of dive into it. Most funds will do, and this is, I'll just walk you through how my fund runs, does this, and some kind of pref. So mine does an 8% preferential rate of return. And that's actually, you can say pref, that's kind of the terminology, preferential rate of return. So what this means is the first 8% of all returns goes to my investor. Okay, so this all comes down to my limited partners or my investor, okay? First 8%. So I tell my investor, hey, I don't make any money unless you make 8% first. Now in my fund, I then do a 2% catch-up, okay? So the 9th and 10th percentile right here, both come to me, the fund manager, okay? So if this year our fund got a 9% return, first 8% would still go to the investor. I would only take 1% here. Okay. Now above 10% in my fund, from 10-20%, we split 80-20. So 80% goes to the investor and 20% goes to the fund manager. Okay. So if in this example, if we got a 20% return this year, first 8% would go to the investor. So 8, next 2% would come to the fund. So 2, and then 80-20 from 20. So 8, another 8 would go here. Another 2 would go here. So I would effectively make 4% and they would make a 16. So if our fund did 20%, we made 16, investors made 16% cash on cash return for the year. I made a 4% return. And you're probably like, well, Bridger, why are we doing this for a 4% return? Like that's so small. What's the big deal? You're not making 4% on your money. These guys are making 16% of their money, right? You are making 4% on the entire fund. So if you run a $1 billion fund, you just made $40 million, right? And this term right here is called carried interest. Okay, carried interest. See if it got cut out there. Okay, carried interest. And this is performance fee type of stuff. So if you run a $20 billion fund, right? It starts to add up. If you're Ray Dalio and you run a $250 billion fund, who would want to learn 4% on that, right? That's pretty darn good when you're earning money on the whole fund, okay? So this is where you get paid here. Now, a lot of funds, you guys are probably asking, well, what about management fees, right? A lot of funds will also charge right over here, somewhere around a 2% management fee. And that's typically taken off the top before anything else. So first 2% would go here and then here. When I started my first fund, I asked my dad about this. I said, wait, so over here you have performance-based fees. These are all, I can change my color here. Performance-based fees on the right, over here on carry. This is all performance-based. And then here is not, you will make 2% regardless. If your fund loses money, you're still making 2%. My dad told me this though, and this is true in the United States. I don't know if it's true in Canada. If you don't charge a management fee, you don't have to have a license to run your fund. In the United States, you need licenses to run a fund, but if you do not charge a management fee, you don't have to have a license to set this thing up and to run it because you're not advising the fund. And so I can dive into what, all the regulations of that, but that put a light bulb on me. I was like, oh, and my dad said this, he said, when you're starting a first fund and you tell an investor, I don't make any money until you make at least 8% first. That's a pretty compelling pitch. And investors really like that. It's kind of you putting your money where your mouth is. And so in my first fund, I still have never charged a management fee in any of my funds. My next fund, we're going to charge management fees, our third fund. But my dad's first fund, they didn't charge a management fee. And I didn't charge a management fee. There's a very easy way to attract investors, to bring them in and to attract them. And now, is that kind of making sense so far?
Absolutely. A quick question on that, Bridger. Do you larger larger funds like the Blackstones and the KKRs of the world, do they have a pref return, or are they just the 2% and the 80-20 split?
I can't speak. I haven't seen Blackstone's offering documents, so I don't know. Most funds I've seen, this industry standard is usually about, they have some type of pref, maybe 7, 8, 6%, somewhere around there, pref that they typically have. And I don't know exactly for those funds, but most large funds will have some type of pref.
It could also be separated between the class of shares in case for people who invest X amount of dollars, then they get the pref, and the people who are below that, so institutional investors or what have you. So
yeah, you can tweak this a lot. And this is kind of generic, right? Some funds you can do 70-30. You can do 70-30 split. My fund, once I hit 20% IRR, we then start splitting 50-50. So I personally make way more money if my fund gets over a 20% IRR. So that incentivizes me to get higher returns. My dad's funds originally, they did, get this, okay? So I'll kind of scroll down here on the timeline. They did a 16% pref. They told the investors, we don't make any money unless you make at least 16% first. And they were like, whoa, like, are you guys serious? He's like, yeah. And they were doing hard money loans, was their first money. So this is hard money. And as you guys know, hard money, typically they have high interest rates, high points, stuff like that. And this was calculated APY, so annual percentage yield, on a yearly. So if they did a loan and they made 20% in 2 months, or let's just say 1 month, keep the numbers round, in 1 month. Well, the APY on that isn't 20%. That would just be the yield. This is the annual percentage yield. So you would be at 240%. Okay, that would be your APY. So yes, investors get the first 16%. And what they did was investors would split with them 50-50 until they hit 18%. And then the fund managers would take 100% of anything above 18%. So you can see and investors were happy. They're like, hey, we're making 16%. This is our 18%. This is awesome. They're telling their friends, and little do they know, my dad and his partner are ripping 222% off of a deal, right? And investors were happy. They were happy. And so it can be very lucrative the way you structure this. Cardone Capital, just to give you another example, I believe they do, I actually called in and got all their numbers from them. They do 6% pref, and I believe a 65-35 split up here, which is pretty low, actually. That's pretty.
Yeah, they're pretty fee heavy as well.
Yeah, and they have I think they have like a 2.5 or a 3% fee, something like that.
And for me to quickly jump in here, we were having an executive meeting in regards to fees and what have you. We were planning to charge in our next deal offering that we have, and we were looking at another team that's been in business for a while, which they're extremely fee heavy. So the team is like, hey, why aren't we charging similar fees? So I said, listen, guys, this team has the brand. When they have their offering, they have the brand, they have the track record. It's going to be difficult for a group like us that's even though our regional asset managers have over 20 years of experience, but it's going to be more difficult without the track record, without that brand, to ask for those fees. Now, the other team is very fee heavy, where they continuously charge fees where they don't need to, for example, like, without getting into it. But that brand is also a huge component of how funds charge fees and what have you.
Exactly. When you're starting, so I focus on people that are starting small. Yeah, typically, I mean, I've loved the zero management fee, because it puts your money where your mouth is with investors. And really in the fund space, you're not trying to become a billionaire on your first fund. Typically, it's by fund 3 or 4 is when you really start making your big, especially in a real estate fund, is when you make the big money. And so your first couple of funds or syndicates is all to build track record. It's all to build relationships with investors. And typically I've seen, and I've talked to plenty of fund managers, they'll say investors on your first fund, they'll give you a trial investment, typically, right? 50, 100 grand, maybe a $500,000. On their second or third investment, they will typically 10x to 20x their investment if you did a good job on their first investment. I've seen that pretty true with my investors and everybody else. So if they give you 500 grand the first time, they'll probably give you 5 million or more on the second check. And by the third check, they're really going to open up their pocketbooks and really write big checks. So about the brand. And Jim Simon's great investor about, has the medallion funds. They charge a 5% management fee and 45% carried interest.
Wow.
And they have people beg. He hasn't taken new money in 10 years. They have too much. They manage like $200-300 billion private fund. And I mean, and they're turning away investors. They don't even take investors. People are, because they have the brand, like you said, Jim Simons has just crushed the market every year for 30 years, right? So it's like, yeah, I'll give them my money. I don't care what the fee is. So.
No, for sure. Great point. And for me to kind of, I do have a dog in the race in this situation, because what the great thing is about investing in real estate funds or real estate syndicate is the risk amount is less, because there is an actual physical asset in place. It's not a venture capital. It's not some business idea. It's not the unknown world of cryptocurrencies. There is an asset in place. You're buying an underperforming asset. You're trying to make it perform better. So at the end of the day, it is a pretty, obviously there's risk about every investment, but that's, that was a point I wanted to bring up. And we're getting close to the end of our meeting here. So if you like,
but I want to touch on one last thing here.
And a couple of other things after this, I want to quickly ask Bridger as well, but go ahead, please.
Bridger, obviously we're inspired by your online presence, as it has a strong focus on education, which we kind of touched on already. But can you please tell us what drives you and how you got motivated in educating others?
Yeah, this goes back to my dad. I mentioned my dad at the beginning. Incredible father, and I could talk about him for days, but he distilled in my mind since I was little a few different things that changed my life. And the one thing he did over and over again to me was he would point out, and everyone knows these types of people, he would always point out people that moved here from South Korea or Mongolia or wherever. They barely speak English. They move to the United States or to Canada, or wherever they move, and in 3 years or 5 years, they've got a restaurant open, a laundromat, and 2 rental properties. And he would point them out. He'd go, how does that guy do it?
Nice.
He can barely speak English, and he's doing better than 90% of Americans who grew up here, went through an education system, no English or native, whatever. How do they do it? And my dad would always instill on me, if they can do that, you have no excuse not to be successful, not to be great, not to go out and do something amazing. And back to, I don't know, the baseball analogy has always stuck with me, is there are plenty of people on the sidelines that are in the peanut gallery on Twitter, making comments, that love to make fun and poke and whatever, but very few people actually get in the game and swing the bat. And I just said, hey, if I get up to the plate and I just keep swinging the bat, yeah, I'm going to fall on my face. I'm going to strike out. I'm going to whatever, but maybe I'll hit a single, and maybe I'll hit a double, and maybe I'll actually hit a home run. And it took me 7 business tries before I had one business that actually made like $100,000, like nothing, right? $100,000. And then after that, like our next couple of businesses took off and gone to the 7-figure and closer to 8-figure range, right? And really scaled up. But it was just me swinging, right? And I've just I'm like, you know what? I'm not going to wait anymore. I'm just going to start doing. And people can laugh, they can make fun, they can joke, but I'm going to do. And I love the quote, people underestimate or overestimate they can do in 1 year and underestimate they can do in a decade. And in my life, I've kept my expenses very low. I just live in a crappy apartment. I don't care, to have all the nice things of life, as long as it allows me to get up to the plate and keep swinging. And that is something my dad has drilled in my head, that we live in the best time in the history of the world to be an entrepreneur. You have an online training like this, August and Ava, for you guys, people can just hop on live and just listen to, and maybe not me, but other speakers that are amazing, right? Hopefully I shared a few nuggets that were valuable, but to learn so much, and there's so much opportunity. I think the biggest, I would hate to be on my deathbed and look back and say, well, in my 20s, man, I should have done that. And in my 30s, I should have written that book. In my 40s, I should have done that project, but I just was too scared, and I live with regret. That's the scariest thing in life to me. And so that's what I think motivates and drives me. And we live in such a time of opportunity. It's never been easier to make money, never been easier to go from the rags to riches story. And you think about the history of the world, about where we're at. If you lived in the 1800s or 1500s, if you didn't own land or weren't in the right family or didn't have the right whatever, you didn't really have a shot, right? Now it's like anybody. Like, it doesn't matter where you come from, and you hear stories over and over and over again of people being successful. Why not you, right? Why not Why not? That's the same thing with funds. I'm like, screw it. I'm sick of the Wall Street elites running funds. Why not me, right? And I had a great father and mentor and other people to kind of help me on that way. And that's why I've been passionate about doing it, and I love it. So there you go.
No, amazing. And quickly share how people can get in touch with you. I've already added your website and other information, but just quickly, what's the best way for people to get in touch?
Yeah, our stuff is called Investment Fund Secrets. So if you want to learn more about funds, how they're structured, investmentfundsecrets.com. I have a 1-hour free training on there. We have a bunch of, you guys have seen our YouTube videos and stuff. You just Google that, or Bridger Pennington. On Instagram, Bridger_Pennington. If you DM me on there, I typically, our team or me, or we'll respond to almost all those comments and stuff on there. So find me there, Bridger_Pennington, Investment Fund Secrets. We have a podcast as well, and we bring on guests and fund managers and stuff. It's been pretty fun. So those are the ways you can find us.
Amazing. And just to wrap it up here, I guess we'll end with the questions we always ask from our guests is, what is your main advice you would have to an investor looking to invest in a fund? What should they look out for? What would be your number one advice? And then I'm just going to ask you the reverse question for the fund manager, basically.
Yeah. So the first one's if an investor is going to look at a bunch of funds and invest in a fund, right?
What would be your advice to an investor? Just even broadly speaking, doesn't have to be about investing in a fund, but just for an investor, what would be your best advice to an investor?
So, as an investor, and I invest in a lot of different funds and different things as well. The things that I look for, number one is, how does that investment fit in my overall strategy? When I'm fairly young, I'm getting this game. So I typically am an active investor. I want to be involved and active. And so I really want to have confidence in whatever I'm investing in. I want to really understand it and know it. Now on the flip side, there's a lot of investors that want to be very passive. They just want to give some money and just not even think about it. So I would first off determine where you're at and what type of investor you want to be. Secondly is, and you'll hear this from most investors, is betting on the jockey, not the horse. So looking at who's going to be running your investment, who's going to be doing that. A lot of times I invest in my own stuff, right? Because I'm the jockey, I can trust in myself. But investing in other people, right? Betting on the jockey, not the horse, I think is huge. You'll hear that over and over again from investors, and having that competence and kind of deciding what type of investor you want to be in there for that. So that's from maybe an investor point of view. And it's a broad question, right? Of where you're exactly coming from. That's typically how I look at things to be brief.
No, and that was great. That was a great answer. Now, as far as someone wanting to start in the investment, in the sponsorship and management of either fund or a syndication, what would be your advice to somebody who's starting out in wanting to manage a fund or manage a syndication?
I would say the first thing that we always tell people is get moving, get started, start swinging the bat, and start swinging it with your own money if you can. So, and if you're starting from zero, start looking, like you guys probably teach this a lot too, start looking at properties, start getting in the game, get on the MLS or whatever it is in your area that you can find real estate properties, or start trading, or start learning the trade and industry, and start looking for that incredible deal. Once you find that incredible deal, and I call it deal, but thesis, could be an investment thesis. Once you have that, everything else is really easy. Raising money, getting the investors, legal, all that stuff, that all follows behind an incredible deal. This is what my dad taught me about raising a fund, because I was so worried when I started out. I don't have the track record, I don't have the experience, I don't have the college degree, like no one's going to invest in me. And he said, Bridger, I want you to imagine with me for a second, if we found a Lamborghini Aventador in Billings, Montana. I was like, okay. And he goes, let's say there's a lady, she needs to sell it on Saturday morning for $50,000. And we've had a mechanic go through this Lamborghini. It's actually legit. It's not broken. It's not like fake or something. It's a legit Lamborghini. We can buy it for 50 grand Saturday morning. And we have a verified buyer on Monday morning that'll buy the car for $200,000. So you can make 150 grand this weekend. One rule though, you can't use any of your own money. You have to raise the money from other people. And the question to me was, could you raise the $50,000 by Saturday? And I kind of thought about it, and I guess asked you guys the same question. Could you find 50 grand? But you can't use any of your own money. And I thought about a former boss or mentor. And it was like, it's guaranteed. He goes, it's guaranteed. If you can get the money, it's a guaranteed 150 grand. And I was like, yeah. Like, you know what? I think I could do that. 3 days, 4 days, I could find 50 grand. Like, and he goes, what about 100 grand? And I was like, I'm like, maybe, like, yeah. I'm like, yeah, you know what? I'm gonna make 100 grand this weekend, like dang straight. Like I could find 100 grand by Saturday. I'm like, yeah, I could do this. And he goes, why? And I go, the deal it's foolproof, right? You said it's foolproof. It's guaranteed. He goes, aha, there it is. I'm like, what do you mean? He goes, the deal was so good. A lot of the times, people and us can't raise money, but we're not that confident in the deal. We don't truly, truly believe that we're going to 3x our money on this real estate property. We kind of hope, we think, but we're not 100% sold. And he said, the moment you had a guaranteed deal, all of a sudden you didn't care about your tracker, you didn't care about your degree, you didn't care about your network. You were going to find 100 grand in 3 days. You're going to scrap tooth and nail for it. And I was like, oh, he goes, that's what you need when you're starting a fund, is you got to have a deal or a thesis or an idea so juicy and so guaranteed, at least in your mind, that you're going to fight tooth and nail to the brim. And that's when sales become easy. That's when raising money becomes easy. That's when all the rest of the dominoes fall in place, is when you have that sweetheart golden egg type of thesis or deal lined up. So that's what I would tell someone that wants to get in this game. Start shopping, start looking. And if it's not you, partner with somebody who already has those deals and work with them together.
Incredible advice.
Long answer, but that's kind of what that's my thought.
Incredible
We
advice.
really enjoyed it, man. We had a lot of fun. We really hope to have you back on to speak as well. And we really appreciate it, man. Thank you.
Thank you so much, Bridger.
Hey, you guys are so great. Thank you so much.
Okay, awesome. Thanks, everyone.
Thanks, everyone. Have a great day.
Happy New Year's.
Happy New Year's.
Yeah.
Bye-bye.